Good to see you guys in here and excited, ready to work. Makes me happy. We'll see if we can get some work done. What is today? Today's the last day of January, guys. Holy smokes. Good morning, K-Dog. Good to see you. Um, Guys, every morning, just like we did yesterday, same thing we'll do Monday. First thing I do each and every morning when I open up charts, they're loading up. I go to news. I go to forexfactory.com/calendar and I just look to see what's going on in the world. For sure, Andy. I thought that might be a good visual. Um, Today at 8:30 a.m. there was an awful lot of red news. It created a little bit of a bounce, not too terribly much. At 9:45 we do have the Chicago PMI, which is medium impact, which does have the potential to move the market, to change its direction, to make it spike. So just an awareness of news, and when it's printing, guys, it's a great habit to get into each and every morning. Only you can make the decision on whether or not you want to trade during news. Personally, I choose not to. Once again, everything we talk about, guys, straight from the Nexgen page, straight from the trading guide. All of the answers, whether it's indicators, momentum, termination, entry, guys, all this stuff is available to you. There's no secrets with Nexgen. We want you to be successful. So everything is available to you. And then my brother has given me the liberty to teach his material in my fashion. And my fashion is simplicity, guys. My goal every day is simplicity. We've taken something that so many people is think is such a complex endeavor. Oh my God, trading, I have to know this and that and these and those and all these things, and what are the earnings and what are the those and what are the these. And guys, the reality is we're going to talk about a pattern. That's it. We are 12 years old again. We're in front of Pac-Man and we're trading the pattern. We're using the pattern so that we don't lose our quarters, guys. That's it. So the easiest pattern to learn, the first pattern I teach every day, is the high probability trend trade, guys. This is a trade where each indicator on every chart agrees for the trade, guys. The triggers are the strongest. There's no termination conditions, nothing between you and your target. And this is a trade that when you follow the rules, this is a trade that typically wins 70 to 80% of the time. This is a trade that creates confidence through that memory of success. And then here it comes. This is the trade that teaches you to read your indicators. This is the trade that you need to be able to discern what the software is telling you, whether or not you have advantages in place, and really whether or not you should be looking to enter a trade. Chart reading is about 90% of your day. It is the majority of every day. Sitting still doing nothing is the majority of your day. 10% of your day will be taking trades because your rules say to take them. But once you learn how to read your charts, once you get comfortable with a couple very basic concepts, you'll understand where the market is likely to continue, where it's likely to go, where it's likely to stop. And all of these are going to work their way into your trading as entries, as targets, as giant red flags to say don't take that next trade. And this is done with only 3 rules. And I know that seems like not enough, right? How could something so successful be so simple? Because it's all you need. So each rule creates an advantage. And it's the accumulation of 3 advantages. Momentum plus a clear path plus an entry area creates the high probability trend trade. The ideas of momentum and clear path, those 2 rules, those 2 advantages, that's your core, that's your basis, guys. Once momentum and clear path becomes evident, once you learn these 2 very basic looks, what happens is you have everything that you need to create a trading plan that's successful, that's consistent, that's profitable. So I encourage new users, focus on momentum and path first. Focus on identifying momentum and understanding whether or not there's something in your way, because once you have that, sky's the limit. These 3 rules happen on only 2 charts. It's all it takes to identify them. There is a large chart. This is a very broad stroke of a brush, and it gives the overall opinion of the market. Um, the large chart, all you really need is the first bar. The first bar on the large chart will define the direction of the market, whether you should be looking for rules to be met for longs or shorts, up or down. The large chart will give you the advantage of momentum using the trigger lines. That's rule number one. And the large chart will identify termination conditions, likely to stop areas, and let you know whether you should pump the brakes and be a little patient or whether it's time to look for an entry. So on your large chart, when the first two rules are met, that's when you go to the small chart. That's when you go to your entry chart. And this is a refinement chart. This shows the inner workings of that one bar that defined direction, momentum, and area. And that refinement process allows you to find your best of the best entry, your highest probability entry. That highest probability entry creates a very manageable trade. It reduces risk dramatically. It increases profit potential exponentially. And that's where rule number 3 comes in. And rule number 3 initially is specific to the trend trade. So 2 charts and 3 rules. And this is why. You've got to understand who you're trading with, who you're trading against. The large crowd is the large chart, guys. I want you to think about this way, group mentality. And this large chart, this large crowd, they create the trends that we'll be following, and they establish the momentum that we'll be taking advantage of. And they react at areas, and they let us know when we shouldn't be looking for that next trade. The small crowd fights the large crowd. Just a bunch of yahoos. If the large crowd says up, they say down. If the large crowd says down, they say up. And they have enough influence and enough money to create these little rifts, these little retracements or pullbacks, as we call them. But they fail typically 70 to 80% of the time, which means that when we use rule number 3, we're defining their failure point. We're defining where it's most likely to happen. We're defining the spot where the market is most likely to continue up with or down with the large crowd, guys. And that's where the precision comes in. So when we talk entries, you're going to hear me say things like, all right, the small crowd has begun their fight. Let's go pinpoint where it's most likely to fail. And that's what the refinement process does for you. We're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. Uh-oh, did Ron say something smart? Like Kenny Rogers, you don't count your money when you're sitting at the table every time. Okay. Yeah, that's smart. Kenny Rogers knew what he was talking about. And he made great chicken. Learn the trigger line and the Fibonacci rules for when it's okay to trade. That's the goal every morning, is that you guys learn these rules, what they look like, what they mean to you, and why we're waiting for them. My job is to teach them to you, and I will do that. We're going to break them down individually. I'm going to give you things to study them. We're going to go look at them. We're going to talk about them. You guys can simulate. You have the software. You have a platform to run it on. I'm going to give you the looks, the rules, everything that you need, guys. So you need to practice. You need to get your repetitions in. And more importantly, you need to post in the room. Everybody's hesitant. I don't want to post in the room, Mark. What if I'm wrong? I don't want to post in the room. What if I lost? I don't want to post in the room. What if everyone laughs at me? Well, no one's going to laugh. And even if they do, you won't hear them. They're in a completely different zip code than you. But posting in the pictures is the first step to getting to where you want to be. And posting pictures in the room, it gives you a private session, which I think is pretty cool. One of the things people always ask for, well, I need private sessions. I need one-on-one tutoring. I need Mark to single me out and teach me what I need to know. Well, guess what? Every time you post in the room, that's exactly what we're doing, guys. You can't see anybody else in the room. They can't see you. So every time you post in the room and you show me a trade and you talk about what you saw and why you did, as I'm going to give you the best feedback I know how to give you on that trade. We're going to talk about your advantages. We're going to look at your entries. We're going to talk about your exits. We're going to virtually high-five and celebrate victories all day long. And we're also going to identify some challenges that you're having and work together to figure out how to fix them. So don't skip that first step in becoming a confident trader. Ask for feedback. As you learn the software, the most valuable thing that you can receive is the understanding of why you did something right or how you did something wrong. And then you can focus on repeating it or fixing it. We will simplify today, just like we do every day. Our first hour is focused on the highest probability trend trade that Nexgen teaches. You have to learn what looks you're going to commit to. You've got to learn these looks so they become easy. And they will become easy through repetition, guys. Repetition creates recognition. And that's where the second part to becoming confident comes in. That's using the spreadsheet that Nexgen gives you. This is the same spreadsheet that I drop in the room every day. And guys, I steal things from you every day to make this spreadsheet a better study tool. The first page is the trade tracking sheet, or the trade tracking sheet, sorry. And the trade tracking sheet is exactly what it sounds like. This is where you're going to track your trades. This is where you're going to take those pictures that you had presented in class. I took a long trade or I took a short trade. Here's the picture of it. That picture will be annotated with my rules. It will discuss momentum, it will discuss path, and it will discuss entry. And it'll show the trade from start to finish because there's lessons in everything. You can choose to identify the momentum or not. You can choose to identify the path or not on the spreadsheet. It's going to be on the chart anyway if you're doing things right. But the most important thing, I think, is going to be the feedback from class. So winners are great. I love winners. I do. I love making money. It's fun for me. It feels good. There's a dopamine kick. But guys, not all winners are great trades. Not all winners are winners that are going to happen more often than they don't. So you may show me a winner and I may tell you you got lucky and it's going to piss you off, and I'm sorry about that. But the goal is longevity. The goal is trading these patterns that have been proven to win more than they lose. So as you take these pictures, as you present them in class, you will get feedback on everything. And maybe the feedback is never missed this trade, but for the new user, typically what you're going to see is the things that are costing you, whether it's trading in determination conditions, or whether it's trading without momentum, or whether it's holding on to trades too long, or getting out too soon. So you're going to begin to see these patterns in the feedback, the things that might be messing with you a little bit. And if you go back and study that spreadsheet every morning, if you go back and look at what you did yesterday every morning, what you're going to do is you're going to be able to answer the question, what worked? And what works is following the rules. What works is having that statistical advantage, that edge every time you take a trade. And you'll begin to see that what doesn't work is when you stray away from those advantages, when you break those rules, when you choose to trade on hope or wishing rather than proven patterns. And you'll notice that what works feels easy and what doesn't makes you nervous and has you moving stops and targets. But this brief historical study each morning, it prepares you for the day, guys. It accelerates the learning. So make sure you're using the spreadsheet. And also in the picture section here, there is a picture how to annotate your charts for the best feedback. The feedback and your annotation, it's not for me. I can read your charts. I want to know what you saw. So I can look at this chart and I can describe every rule that Nexgen teaches. I understand the entries, the exits, all that stuff. But what I need to know is, what did you see? Did you see strong triggers here, or did you see weak triggers here? Because one says, yes, you're doing it perfect, and the other says, hey, let's have a lesson, let's talk. Let's make sure that we can clear up exactly where we're having a challenge here. Same thing with terminations, entries, exits, all that stuff. So make sure that you're being thorough. The next tab is the basic rules, guys. I used to call this the 101 tab, but I like the basic rules tab better. In the green, that's what it looks like to have your rules met individually, on their own, not a trade, just one rule being met. In the red, it shows you when you should not be trading, when your rules aren't met. I'm going to give you something so that you can use this. We're going to give you some weekend homework with it. The next tab is the client trades, guys, and there's over 400 pictures of strong triggers, momentum, entries, and the Nexgen users putting those together to create their own trades. This is a great study guide, and it really does clear up a lot of questions and misconceptions, because you'll begin to see a lot of the same thing over and over. There's the entry sequences for long and shorts, there's management, Very basic in the beginning. I'm going to give you a plan for this, but guys, management and you and entries and everything grows as you grow. So keep it very basic initially, but you're going to grow beyond it. And once you're a chart reader, once you're good at reading your indicators, you're going to begin to see patterns. You're going to begin to see the same thing. You're going to recognize these things that seem to be happening every day. Some of them may work their way into your trading plan. Some of them may keep you out of trades, but you will recognize them. Take those pictures, drop them in the room. Say, Mark, I keep seeing this. What's it mean? What am I looking at? And then finally, pictures, 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 guys. Fill up your build your trading plan. These are the pictures of your rules being met in green. Learn the patterns so that they become easy. As you work on management, there's opportunities. The patterns that you see show up here. So that's the same thing we do every day is what we're going to do today. We're going to learn, you're going to practice, we're going to keep it simple. That's the long and the short of it. If you have a question during the class, I want you to raise your hand. I want you to interrupt. I want you to ask your question through pictures. I want you to drop it in the room and say, hey, Mark, this is about the terminations you're talking about. Hey, Mark, this is about the momentum you're talking about. And I'll look at your picture. We'll look at it. We'll answer all your questions. Don't be shy, guys. Be very, very selfish with the time in this classroom. It's impossible to monopolize it. I won't let you. Or I will let you, and we'll talk about whatever you want to talk about for an hour if that's where the lesson needs to go. So what are we looking at on our charts? I think this is important to know first, and this is just language. This is all it is. We're defining some stuff. The first thing is triggers. Triggers are on every chart you're going to look at. They're going to be on the big chart, the little chart. They're going to be working together. So there are small triggers, and this is important. It takes two lines to create the small triggers, and they're a fast-moving average. And then there's large triggers. It takes two lines to create the large triggers. And this is important because the lines don't run independent. So you're going to hear us talking about trigger lines through an area. Anytime you hear that, both lines of the triggers have to be through an area. So small triggers and large triggers, at first we're going to use them to define momentum. They're going to define momentum on any time frame. And then we're going to use them to define trouble. So triggers show up everywhere, and they show up in all three rules. And then there's areas on your charts. Large chart and small chart has areas. This is just naming them. Divergence highs, divergence lows, support, resistance, one-to-ones, mid-band. Just so you know the language, so you know what I'm talking about. When I say a one-to-one, you'll always know that it's these yellow dots. When I say support, it's always blue Fibonacci support. Divergence highs and lows, they're always the same. So just know the language so that you can use them in the rules. And rule number one says that the large chart, that chart that leads the way, the big slow chart, that it must have strong trigger lines. Large chart defines direction, momentum, and areas. And we're going to let it define direction right now. If the background on your large chart is green, the market is in an uptrend, I'm looking for rules to be met for high probability trend trades long. If the background on my large chart is red, I'm in a downtrend. I'm looking for rules to be met for high probability trend trades short. I'm not just going short. I'm not just selling the market because I see red. I'm looking for rules to be met for that high probability trend trade short. Trading with the trend. The trend is your friend. Oldest cliche in trading. In an uptrend, in order to have strong triggers, the background's green, and both my small and large triggers must be green as well. If the colors don't match between the background and the triggers, or if the colors don't match between the triggers themselves, you'll never have strong triggers. Strong triggers means that the smalls are above and away from the large are wide. The space between the two, that gap between small and large triggers, in an uptrend, it lets me know that the odds are favorable for the market to continue up. In a downtrend, it lets me know that the odds are favorable for the market to continue down. I mean, that's about as easy as we can make it. If there is separation and the colors match, you have strength. If the colors don't match, you don't. If there's no separation, you don't. And when there's no separation, even if the colors match, this is what we call weak triggers. And weak triggers, anything can happen up or down. So with strong triggers, the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum is what you're going to hear in this classroom all day long. You're going to see annotated charts, OFM. And guys, it's rule number one for a reason, because odds favorable momentum, strong triggers, pushes the market in the direction of the trend. It's like a loaded down semi, and it's hard to stop. Odds favorable momentum is the look that you need when areas have the potential to break. Odds favorable momentum will even cover some of the mistakes that new users make. And odds favorable momentum in an uptrend from the point of separation until they return, this is where we're looking for our trend trade opportunities. And on the large chart, that slow chart, when price gets below the midpoint of a bar, it creates these tails or these wicks. These tails and wicks are the pullbacks on the smaller, faster chart to Fibonacci support. You'll be using these tails to study, but you'll be using the small chart to pinpoint where these tails are most likely to happen. So when you go back and study a little bit, you're going to go back and say, wow, look at the momentum. There's nothing in the way. There's one of those tails. Let me go see if that was a potential entry. And the same is true for the downtrend. From separation to returning, this is your opportunity, guys. This is where the best of the best happens. This is where your highest chance of success comes from. So rule number one, and let's just go to a large chart for grins. Separation means strength, and it pushes through areas. Separation means strength. And when the smalls are inside or the colors don't match, it means weakness, and it really is that easy. Can you guys give me a why? If you're with me, separation, odds favorable, a market that's likely to continue in the direction of the trend, guys. This is rule number one. And it's rule number one for a reason. Thank you for that, Ron. Once I have momentum, it's important to me that I have room to my profit targets. Once I have momentum, it's important to me that I don't have any termination conditions, that I have that clear path. Because as loaded down as that semi is, if I've got a giant brick wall in front of me, it's going to be hard to get through. So termination conditions, they're Fibonacci indicators, based indicators, that may reverse the market. And you're going to hear that in this room a lot. It may reverse the market. It might reverse the market. It could reverse the market, but it's not definitively going to reverse the market every time. These areas, it's going to be a comparison of the area, support, resistance, one-to-ones, divergence highs and lows. And it's going to be against the T3 trigger line, strength and location. So once again, the trigger lines are going to play a role, but now they're no longer going to be defining momentum. They're going to be defining whether or not these areas on the large chart are likely to stop the market, or likely to create an untradeable bounce, whether they have the potential to break or whether they've been broken completely. These areas on the large chart, these are where the large crowd is making decisions. These are the areas where the buyers are buying and the sellers are selling, where fights are happening, where reversals are most likely to come from. And if you do a little study, you'll actually be amazed at how effective these areas are. So how do we define what is a termination condition? Well, decisions are being made at the areas, so we're going to let the market get to the areas. We're going to let price reach an area. That's the first step. The dynamic Renko bars reach Fibonacci resistance, or your dynamic Renko bars trade down and reach Fibonacci support. And it's not just a fib, and I always want to be clear on this. It's not just a fib. It's any of these horizontal lines on your large chart. So it could reach Fibonacci resistance, it could reach a divergence high, or it could reach yellow one-to-ones at a high. Or it could reach Fibonacci support, a divergence low, or yellow one-to-ones. But when price reaches the area, all you have to do is ask yourself, where are my triggers? That's it, it really is. It's pretty easy. Price reaches the area, where are my triggers? Well, if my triggers remain below resistance, remember, two lines form the small, two lines form the large. If two lines of the small don't get above, if two lines of the large don't get above, this is a termination condition. This termination condition could create a big untradeable bounce. This termination condition could create a fight, and it's not uncommon to watch the buyers and sellers duke it out right at these key areas. This termination condition could break, or this termination condition could reverse the market completely, making those large triggers go from green to red. Those are the options, and I never know what it's going to be. So when price reaches an area and my triggers remain below a resistance, rule number 2 is not met, and it's just no trades into the area. This is where I have to sit on my hands. I'm not just going short because everything says up, but I'm not going long because it could create this reversal. And if it does create the reversal, this is what we call a strong top. A lot of people confuse a strong top for rule number 1 for the high probability trend trade. It's not. A strong top is just a very impactful decision made by the sellers at resistance to take over and push down. And when the rules are met for a high probability trend trade after a strong top, that's the highest chance of success you have with that trade. And then the market pushes down, it reaches Fibonacci support. Where are my triggers? They've all remained above support. Man, I don't know what the reaction is going to be. I have to do nothing because rule number 2 isn't met. It's either going to bounce, fight, break, or roll. And if it rolls to the upside, now it's a strong bottom. Again, the precursor for the highest probability trend trade you could take. Rule number 1 for about 3 other trades. So areas hold. And we're just going to go see how often they did. This is crude oil. And this is from, I guess, yesterday evening. But I want you to see something. Price reached a divergence high. The triggers didn't break. And look at the retracement. Right back to support, no triggers through. To resistance, no triggers through. Remember, 90% of your day is spent doing nothing. The momentum pushes it down directly to a divergence low and support. And there's that untradeable bounce. And that untradeable bounce stopped right at resistance. The market continues down. Support creates another untradeable bounce directly to resistance. Back to retest support. Sure enough, the market reverses right to yellow 1-to-1s with all the triggers below. And ladies and gentlemen, if you do this and you see just how often these areas stop forward progress, you're going to be less inclined to trade into them. Does that make sense? Everybody good with that? That's defining a termination condition. We just watched it in crude oil. That's not a hand-picked picture. That's not me going back 6 months to try and convince you of a rule, guys. This is me showing you that more often than not, rule number 2 is going to take money out of your pocket if you choose to trade into these areas. But they do break. So let's go through the 3 options at a fib. The first option, and the first thing that happens always, is price reaches the area. If the triggers remain below resistance, your best avenue is to sit on your hands and wait and see what the reaction is. If this termination condition does not reverse the market, if the market is going to continue up, the next thing you're going to see is this look, where the small triggers, both lines of the small triggers absolutely smash through the area, but your large triggers are kind of lagging behind and they haven't made it through. Price reaching the area is the end of price. Once price reaches the area, the triggers tell the story. If the smalls are through but the large are not, with odds favorable momentum, this is key, you have to be able to identify momentum, then this Fibonacci resistance has the potential to break. Because of the momentum in the market, this area has the potential to break, but it's just potential. The area is not broken, which means that trades can be taken, but they must be managed assertively. I'm going to give you a plan for taking this one. This is what we call a 50-50 trade, and it's nothing more than a reference to where the triggers are. 50% of my triggers are through, 50% are not. And then once the small triggers and the large triggers, both lines of each, get above the resistance, resistance is officially broken. It behaves as support, and your path is clear. Rule number 2 is met. And your path remains clear until you reach the next area. And then once you reach the next area, we go right back to number 1. Same in a short trade. Price reaches support in the moment. It's a termination, absolutely no short trades, guys. there's no reason to hope an area breaks. Just let it break, or at least give it the potential. Let the small triggers smash through with momentum, and the large triggers, lagging, 50-50 trade, must be managed assertively. And the path isn't clear until small and large get below, support behaves as resistance, and the path remains clear right until you reach the next area, and then the process starts over. So let's go back and look at that crude oil one more time. Terminations just everywhere, right? And then we get some of those, this one didn't even give us potentials to break. There's the potential to break right now. The smalls are through, but the large are not, and this Fibonacci area is not broken. It's only the potential. Let's go look and see if it happens on other markets. This is the S&P. This is the other one that I teach on here. From resistance, potential to break but didn't. Back to resistance. Here we get a clear path and it just doesn't go. It happens sometimes. From resistance to support to one-to-ones to support. There's a fib, there's one-to-ones, there's resistance. Guys, over and over, these fibs are making a difference. They're giving you a very clear indication of where decisions are made, and they're teaching you to be patient, because there will be times when your path isn't clear because the areas are stacked a bit. 90% of your day, guys. It's okay to do nothing. It's all right to sit on your hands. It's okay to do nothing. It's okay to not be in a trade. The futures markets trade billions of dollars every day. You are going to see the potential and be able to, is my hope, capture $400 to $500 a day, putting you in a six-figure income with your trading. That's the goal. Not to be in every move, to be in the best moves. Not to hope an area breaks, but to simply let it clear and trade to the next area, guys. That's day trading, having an edge, trading a pattern that has been proven to win more than it loses. So momentum leads the way. Rule number one for me is an absolute must. If I don't have momentum, I don't even think about taking a trade. Once I have momentum, this becomes a flow chart. If my large chart has strong triggers, then my large chart must have a clear path. If my large chart has a clear path, then I will go to the smaller chart. Only then will I go to the smaller chart. And I'll refine my entry. I'll take that big broad stroke of a brush, and I will define where the market is most likely to continue using rule number 3. There is one time when I have odds favorable momentum, strong triggers, when I have a clear path on my large chart, when my large chart has given me everything I need to look for an entry, there is one time when I can't take that entry on my small chart. This is the only time the small chart will give you a termination condition. I'm going to say that again. This is the only instance when the high probability trend trade rules are met where you'll have to say to yourself, okay, no entries. And that's 3 divergences in the same price range. Every time you hear divergence, you need to think loss of momentum. If the market loses momentum 3 times in the same price range on that smaller, faster refinement chart, this is a termination condition. This is rule number 2 not met. This could terminate the trend and create a big untradeable bounce or a fight that goes the other direction. Same thing at a high. These become more powerful when you have weak triggers. The same lesson from rule number 1 on the large chart. When my smalls get inside of the large and that weakness is there, I'm coupling this visual loss of momentum with 3 losses of momentum. Becomes more powerful still if it creates a little head and shoulders. The final pivot's higher than the previous or lower than the previous from a high. That is the only time I will let the small chart talk me out of a high probability trade. But if it's not there, this is where the precision comes in, guys. This is where you're going to wait for the small crowd to fight. This is where you're going to use a limit order to buy or sell a pullback in an area. You're going to literally wait for the small crowd to fight, and you're going to pinpoint exactly where their failure is most likely to happen. And you're going to do that by using a limit order to buy or sell a pullback in an area. We're going to use fibs, mid-bands, and yellow one-to-ones. But the key is that we want it to be in triggers. We want those areas to be in triggers, because triggers are going to define where that fight is most likely to go. Triggers are going to define where the retracement is most likely to happen. price returns to the large triggers on both charts. Big chart, small chart. Price always seems to snap back to those large triggers. So on your entry chart, there's the 5-1 large triggers, which are smooth, and there's the synthetic triggers, which are stepped. And these are the 13-2 large triggers. We've put them both on the entry chart because they define where the retracement is most likely to occur. That's all it is. Trigger lines define where the retracement is most likely to occur. It's the areas inside of those trigger lines in that retracement zone that are going to define where the bounce is most likely to happen. So for you brand new users, the best of the best, the lowest risk, the most precision comes from having what we call favorable large triggers. Is when your large triggers and your synthetic triggers are overlapping, they're wide in the direction of the trend. They're like two snakes riding piggyback. Because when they're overlapping, the area where the retracement is most likely to occur is one spot on both charts. And then when you put a fib, a midband, or a yellow 1-to-1 inside of those triggers, this is going to be the window that creates the smallest risk, that offers the highest profitability, and really gives the absolute most precision. So let's define an entry. Guys, I want to show you on client trades, long and short, broken down into the same steps we're going to talk about. So feel free to use that as a study guide as you learn your entries. Rule number 1, or rules 1 and 2 must be met on the large chart. This is imperative. Having the advantage of momentum and a clear path is what sets you up for success when you're finding this entry. And this is what your small chart's going to look like when those rules are met. It's more than likely going to be screaming to the upside. You're going to have strength. Everything's going to be going up. And we're going to wait for a reversal bar. You're going to wait for the small crowd to fight. You're going to wait for that retracement to begin. And that reversal bar signals the beginning of the retracement. The reversal bar is not your entry. When the reversal bar prints, you're not going to hit buy now. You're going to define where that retracement is most likely to go. And that's going to be the trigger lines. So from the highest line of the triggers to the lowest line of the triggers is where I expect the retracement to go. I don't know if it's going to stop up here, if it's going to go down there, but I do know that this box represents where the retracement is most likely to happen. And the tighter the triggers are, one on top of the other, the smaller this area becomes, and this helps with accuracy. Triggers are not my entry. My entries will come from areas inside of those triggers. So once I identify my trigger lines, I do understand where the market is likely to return. But I need an area inside of triggers. Areas can be fibs, mid-bands, or yellow 1-to-1s. And this is consistent on every trade. Fibs, mid-bands, or yellow 1-to-1s. Areas are not pink 1-to-1s if you have those on your chart. Areas are not divergence highs and lows. Triggers aren't the entry. Areas are where the best of the best comes from. So we're going to create a little window. And that window is going to go from the highest point of support to the lowest point of support inside of triggers. And while the triggers define where the retracement's most likely to happen, the area defines where the bounce is most likely to occur. So once I define my areas, and guys, that reversal bar is still sitting there, I'm going to activate a limit order. You're going to activate a limit order. And you're going to put it about 2 ticks above the highest point of support inside of those triggers, because your large chart is screaming to the upside. Your large chart has absolutely nothing in the way to create a bounce, and you have just pinpointed where the small crowd is most likely to fail, and you're going to get in at the very top of that failure point. You're not going to trip over a couple pennies to save a few dollars. And man, if that market can push down, if that small crowd has it in them, and they reach your limit order, you're in a long position. You are in the market. You have bought the market. And you have the advantage of a market where the odds are favorable for it to continue up via strong triggers. And you have the advantage of a clear path giving you room to your targets because no termination conditions were present. And you have the advantage of having entered precisely where the market was most likely to continue with that uptrend, guys. This is your highest probability trend trade entry. This is the best of the best entry. This is the one that typically wins 70 to 80% of the time. This is the one that reduces risk. This is the one that maximizes profit potential. So you've got to learn that recipe from start to finish to pinpoint your entries, guys. And I'm going to tell you, the rules say, as I teach them for brand new users, wait for the reversal bar, wait for the pullback, wait for the fight to start. The reality is the market may be trading over here, and you're already looking at triggers. You're already looking at areas. You're already rooting for the small crowd to fight. You will call your shots. But once that reversal bar does print, you need to look at the trigger lines. Where's the reversal? Where's the retracement most likely to go? And it's likely to go from the top of the triggers to the bottom of the triggers. And then you're going to say, well, where's it most likely to bounce? It's most likely to bounce somewhere from that highest point of support to the lowest point of support. I don't know where it's going to bounce in there, if it's going to bounce, but I do know that I want to activate a limit order 2 ticks above that highest point, because the large chart says good luck stopping us. And the great thing is once you can build this little window, once you know from the highest to the lowest point of support inside of favorable large triggers, once you understand that this is where the retracement is most likely to happen, it gives you the mindset that anything on the wrong side of those triggers, anything beyond those triggers, that's not where I want to be. That's not where I want to try to enter. This fib is not a part of my window. This fib is on the wrong side of everything where my edge is no longer in play. For a short trade, I'm waiting for the reversal bar. I'm waiting for the fight. Doesn't guarantee an entry, but that reversal bar says find your triggers. Where's the retracement most likely to occur? And then that tells me find the area inside. Where's the bounce most likely to happen? And that tells me put your limit order 2 ticks below that lowest point of resistance and hope the small crowd has it in them. And any line on the wrong side of the triggers, any line beyond the retracement, any line beyond the area that should create a bounce, not a part of the equation. My advantage is gone. My edge is missing once I get to the wrong side of the triggers. I don't know if these areas will stop the market. I don't know which one could. I don't know if they will at all. I don't know if it's going to go further. This is where I no longer want to be in the market. This is where the market should not go. And that's a very important phrase. Should not go is where your initial stop is placed. So your initial stop after your great entry is going to be 4 or 5 ticks beyond those trigger lines. And anything that wins 70 to 80% of the time. Hey, Harry, welcome to the room. Great to have you. First day, I love it. Awesome to have you. And I'm recording this day as well, Harry. And the first hour is nothing but the most basic rules. And we just got through entries. So I would encourage you this week and go back and watch the first hour a couple times, but please feel free to ask all the questions. Guys, once you've taken your great entry, your initial stop goes where the market should not go. Anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. Losses are a part of trading, guys. Losses are a normal part of a positive equity curve. Losses are not a failure. Losses are not a defeat. Losses are not a negative if you're taking the losses when the advantage was present, when the pattern was there, guys. And it's just part of it. But the great thing is, more often than not, when you have momentum, when you have a clear path, when you get in at the area where the market is most likely to continue, you're going to get a reversal bar in the direction of your trade. And this reversal bar is going to allow you to redefine where the market should not go. This reversal bar is going to allow you to reduce risk a couple ticks above it or a couple ticks below it. And I'm going to give you a plan that sets all this in motion and gives you pictures. And it's not uncommon to see you guys take these sniper-like entries, these beautiful low-risk entries, reduce the risk even more, and then just dag-nabbit, and pardon my French there, but dag-nabbit. The small crowd has it in them, and they push up anyway. And I want you to see this picture, and this is one of my study pictures, is price reaches resistance. I'm in 2 ticks below it. I get a reversal bar, and I'm sitting on 3 or 4 ticks of risk. And even though the trade doesn't work, it's a tiny little loss. It's an easy to deal with loss. And when your losses are small and your wins are big, guys, it's hard not to come out on the right side of things. So that's the high probability trend trade. It takes 2 charts. It only takes 3 rules, and it takes 2 charts. And the large chart leads the way. The large chart must have momentum with strong triggers, and the large chart needs to have a clear path, or at least that potential to break, because all your triggers are getting above the problem areas. Remember, on the large chart, it's a 1-bar scenario, and you're making the decision to enter the trade somewhere up top here. Let's take a picture and talk about a couple things. Your decision to take an entry is happening right about here at the top of that bar. And when it's time to enter a trade, you might say to yourself, man, I only have 8 ticks. I only have $80 worth of profits to get to that trouble area, to get to that target. And this top of that bar is where the reversal bar prints. And this tail is the tail that you predicted with an area inside of favorable large triggers. And what happens is when you learn this methodology and you learn to trust this methodology, that 8 ticks turns into 30 ticks. That $80 worth of potential profit turns into $300 worth of potential profit coming in from those areas inside. So you can use this to study. You can go back on a large chart. Let me close that out and let's go to the live market and see if we have one. You can go to your large chart, and when you have momentum and path in place, look for those tails. Here's an idea of where it was the potential to break. And when you circle that tail on the large chart, scroll back on a small chart. This is your study, guys. This is how you're going to develop a little faith, a little trust. Trying to figure out where that circle was. I thought it was 1800 there. It is. Looks like there was a huge spike. And that huge spike with the potential to break came right back to the mid band, but it was on the wrong side of the triggers. Maybe not your highest probability look. So you scroll back and you say, all right, let's see another. Let's look for a tail. And man, the S&P yesterday was forcing patience. So maybe you're like, okay, I can't find what I want right off the get-go. Let me open up another chart. Let me go see if I can find some of these instances. There we go, on crude oil. Termination, reversal, odds favorable with the potential to break. There's a tail. What did that tail look like? Right to the mid bands. And it's inside of a pretty big retracement zone. But it did bounce right off of the areas inside of that retracement zone. And let's just move the circle over. Potential to break. Strong triggers. Whoop. And it did it again. The triggers defined where the retracement was most likely to happen. The areas inside show you where it's most likely to bounce, and it never gets below those triggers, guys. Right off that termination, and off it goes, non-stop to the next one. So this is your pattern. You've got to learn to trust this pattern. You've got to learn to recognize this pattern. And in order to get to where you want to be, you've got to recognize a couple things pretty quickly. You've got to recognize triggers strong. You got to recognize clear paths. So the fastest way to get there, the fastest way to become a chart reader is to go take pictures. I believe, it's my firm belief, that taking trades in your first couple weeks is important. It's important to understand how the software works. It's important to practice. It's important to get comfortable with NinjaTrader. But I also think that there are a lot more benefits to be had from taking pictures. So supplement your simulation with picture taking. Go take 25 pictures of strong triggers. It'll take you 30 minutes to do it probably. Go take 25 pictures of weak triggers, of a clear path, of termination conditions. Go take pictures of those entries. Circle those tails. Find those entries. But it's not just about taking pictures, and this is what's important. You need to annotate your pictures. You need to talk about why. Put the whys on the chart. Create the connection between the look and the why it's strong triggers. So the arrows point to the look, but the words tell me why the look is important, because the smalls are above the large. Wide triggers, odds favorable, rule number 1 met. And what happens is you're creating this little neurological connection between what it means to see strong triggers and what it means to you in terms of advantages. Strong triggers, odds favorable, momentum. And you're going to do the same for weakness. And these are all coming from the spreadsheet. Look at this. Smalls are now inside of the large triggers. Weak triggers, not momentum. Rule number 1 not met. And the picture also shows you a pretty killer reversal coming from both angles there. So I'm going to encourage you to take a lot of pictures. I'm going to show you my picture count. So far for 2025, I'm at 740 pictures. We're not through January yet. Last year I did over 8,500 pictures. So take those pictures, guys, fill that spreadsheet and talk about the whys. And eventually you'll piece those 3 pieces. You'll take those 3 pieces, those individual pieces, and you will turn them into a trade. So as you're taking those pictures, I'm also going to give you the high probability trend trade checklist today. This is 4 items. Only 3 of them are rules. The first thing on the checklist is the market coming from a strong top or bottom? Is it a no triggers through termination that reverses the market? Not is it a fib that reverses the market? Is it a termination condition that reverses the market? If it is, that's the precursor for the highest probability. That's the best of the best. These strong tops and bottoms tend to push the market the other direction with some pretty crazy aggression. It's not mandatory, but it does add warm fuzzies. Do I have momentum? There's strong triggers, there's weak triggers. Know the difference between the two. Only one of them says go look for termination conditions. No triggers through, not a clear path. I'm going to sit in my hand and wait for the reaction. When the small triggers smash through but the large haven't, I know it has potential. I will make it to that trade. That will become a part of my plan, and most of my trades are going to have this look. But that clear path, I will never question my entry. I will always go look for it. What you waiting for? What are you looking for? Where are you entering? All of that laid out for you. And then the second page, print this out. Put it on your desktop. Hold yourself accountable for following rules. And even more importantly, I think, because you're going to go back and study every trade that you take, because you're going to use language to associate with pictures to create a connection. Use the language from the checklist every time you annotate. Talk about odds favorable, strong triggers. Use the word no termination, clear path. And most importantly, for you guys working on entries, use that phrase, area inside. Inside has got to be a key part of what you do inside of favorable large triggers. So you're going to get this as well. Nobody has ever marked yes to all 4 and done worse than 70%. True story. I've had a lot of people try. Nobody's pulled it off. And then I'm going to give you the KISS plan. What is the KISS plan? The KISS plan is a stepping stone in your learning journey. The high probability trend trade is your first trade. The high probability trend trade is not your only trade. The high probability trend trade is the trade that optimizes your chances of success as a brand new user while you learn to read your indicators, and that's exactly what the KISS plan does for you. But through simulation, study, class feedback, and continuous practice, you will craft a plan tailored to your personal goals based on your experience reading the indicators, guys. Once you can read your indicators, once you're comfortable recognizing advantages, you will find more. My favorite phrase is that the high probability trend trade is not your get-rich trade, but it's the one that sets you up to see your get-rich trade. So the simple plan, don't fight the large chart, guys. What does that mean? That means if the trend is up, don't go down. If the momentum is up, don't fight that momentum. If there's a termination condition in the way, don't trade into it. I'm not telling you what to do, but I'm telling you how to avoid the most common mistakes that traders make. Teach yourself that level of patience. Insist that the market is giving you what you want rather than you settling for what the market is doing. Don't fight the large chart. And then define your entry. Great entries should create manageable trades. Great entries should reduce risk. Great entries are nothing more than patterns that put you into the market where the market is most likely to continue. So define your entry, learn the rules for your entry, and commit to your entry. Learn to trust your entry. Um, Pilot's first rule, don't hit none. I like it. Hey guys, once you're in the market, you've got to manage it. You've got to do something with that grade entry. So the KISS plan has a management plan attached, and this management plan is designed to get you paid. This management plan is designed to define where the market shouldn't go and having you put your stops there. This management plan is designed to create confidence and to create trust in what you're doing. So your management plan is dependent on you entering the market where the market is most likely to continue. Your management plan is dependent on your understanding of the entry rules. And once you enter the market where the market is most likely to continue, guys, your initial stop is 4 to 5 ticks below those trigger lines where the market should not go. And once this happens, we go right back into if then, the same way we did on entries. If I enter the market at the area inside of favorable large triggers, then my stop goes where the market should not go. We have defined where it should not go as 4 or 5 ticks beyond the triggers. And at this point, there's absolutely nothing to do. You are either going to get stopped out, and you're going to learn to accept that stop out, because anything that wins 70 to 80% of the time has to lose 20 to 30% of the time. Math doesn't work if it doesn't. But more often than not, you're likely to get a reversal bar, a confirmation bar in the direction of your trade. We call this one a confirmation bar because it's confirming that the rules are met and the market is now going in the direction that you anticipated. A reversal bar in the middle of nowhere confirms nothing. A reversal bar from an area inside of favorable large triggers, when you have the first two rules met, confirms that your trade is going in the direction it should. So if I get a reversal bar, then my new stop is 2 ticks below it. And once again, there's nothing to do. I'm either going to get stopped out for an even smaller loss, which that feels good as far as losses go, or it's going to run to my first target. The KISS plan is built on the premise that base hits add up, that small profits turn into large profits. So the first target in this KISS plan management, remember we got 2 contracts here. It says it in the KISS plan. I don't know if I mentioned it. My first target is $100 away. $100 away. 8 ticks on the S&P, 10 ticks on crude oil. I'm more concerned with the ticks than the money because right now I'm focused on the process. But when your first target is hit, that's $100 into your account. That's $100 that the market can't take away from you. That's $100 creating confidence. That's $100 worth of drying up sweaty palms. And guys, that $100 is a success. That $100 feels good. And there's nobody in this room that would step over a $100 bill on the sidewalk. And then once you get that $100, this is where you're learning to trust your large chart. You're going to move your stop to break even. You're going to say, you know what? I just got paid and I have absolutely no risk. I feel pretty good about holding on for the second target. I feel okay about just letting the market do what the market's going to do. And if it goes to your second target, guys, that's only $200 away from your entry, and that's a $300 trade. You're developing trust. I'm going to encourage new users to let your trades play out, to not move your stops, to not move your targets, to be okay learning the process rather than focusing on the result. One $300 trade a day, if that's the best you do every day, is a $75,000 year. That's pretty cool. If you throw in a break even, now you're in 6 figures, guys. One of the things, if you ever spoke with a Nexgen salesperson, they say you're going to see the potential to make about $500 a day pretty easy. I believe that. I believe you should see the potential. By the end of the first day, looking at what we do and the charts that people post, you should know that that potential is there. You've just got to learn how to capture it. You've got to learn the looks, the patterns. You've got to learn to trust it so you can find your for $500. And guys, that's the only thing that Nexgen can't give you. Giving you the rules And we've talked about what they mean to you. Yeah, I just showed that, Gary. 252 trading days in a year, though, typically. We learn the rules, what they look like, what they mean to you, how to study them. There you go, Gary. So you don't have to do math for the class. Pretty cool, right? Ta-da-da. You guys can simulate. You can practice. You can get feedback on everything that you do. 15 hours every week live. I'm here and I want to see what you're doing. I want to talk about what you're doing and what you see and if you can do it better. You've been given a plan to follow. You've been given a plan that's actually gotten people funded in those prop firms within their first 30 days, keeping it very, very simple. Every morning I say, I'm going to give you everything that you need to be successful with the software. And every morning I give you the spreadsheet so you have a place to study, a place to track your trades. And every morning I give you this zip file that says all you need. And inside of that zip file is where you're going to find Chart Reading 101, Daily Goals, Exit Conditions. You're also getting the PowerPoint that I used to teach this classroom with. You're getting those high probability trend trade checklists. You're getting the KISS plan. And you're also getting probably my favorite document that I've written in the last couple months, the Trend Trade Simple. If you don't think this can be easy, if you don't think this can be low maintenance and simple, guys, I have taken everything that I've just talked about in the last 2 hours or the last hour and consolidated it into 2 pages. From the rules to the charts to the indicators and how to use them to identify the highest probability trend trade. That's in the zip file as well. This is the first hour of every classroom. So Harry, welcome to the room. This is the first hour every day. I say the exact same thing over and over. I give you the exact same thing over and over. And I'm going to share this before we go into the second hour. The key to everything that we do is the foundation, guys. Building the foundation, learning to look at a chart and say out loud, scaring your pets, I have this advantage. This is my advantage. I see this advantage. Knowing that it takes advantages to get into that trade. So understand the basics first, guys, and then we're going to compound every day, 1% better every day. So for you brand new users, I blanket you with very conservative rules with the recognition of advantages, and I give you a solid plan that optimizes your chances of success as you learn to read the indicators. And I love that phrase, it optimizes your chances of success. It is the absolutely, positively best way you could ever enter a trend trade. It doesn't mean it's the only way to do it. So for you new users, all termination conditions are bad, and no momentum is bad, and areas beyond triggers are horrible. Blanket rules because it increases the likelihood of success. They are not always bad. But you have to have the experience to know when to use exceptions, guys. You have to be able to recognize what you're up against so you know when it's time to manage a little more assertively. And just like anything, the more time you spend with it, the more time you see. The more time you spend on the blue slopes, the easier the black slopes become, right? And this opens doors for you. So learn the process that yields the results. Learn the very basic rules. Learn how to manage a trade. Learn how to take your emotions out a little bit. And let it be very, very pragmatic. That's where the KISS plan comes in. If you keep it that basic, if you follow the simple rules and you're okay not looking for all the trades, but rather looking for the best trades, you can find an extraordinary level of success, guys. And I've watched it repeatedly over the years. And the further new users deviate from the simple, there should be a comma there. Deviate from the simple, guys, the longer they take to learn how to be comfortable with the patterns. So typically you would think that because there's a million opportunities, you should learn a million opportunities, guys. The more you stay focused on that one trade that gives you everything you need to be profitable while you learn to read your indicators, you're going to start to see more opportunities. So question everything, and I mean that. Question everything. Stop this classroom cold in its tracks if you have a question. I want you to learn. But I also want you to give yourself a little grace, guys. You're brand new. You're brand new and you're learning the greatest job you'll ever have. And it takes a little time, it takes a little effort. And the one thing that I know to be true is that what you put into this software is what you're going to get out of this software. And is it just me, or did crude oil go from termination to termination? And that's where that big ugly bounce just happened. Pretty cool, right? We knew about that area. If you were in a short trade, you knew exactly where getting paid was your best chance of success, rather than hoping the area broke. They break, but they hold more than they don't. So are there any questions as we get ready for the second half? Is there any question that 6135 could stop the market, might stop the market, could create an untradeable bounce, or it could break? I don't know what the reaction's going to be. So I choose to do nothing until the indicators tell me that my path is clear. Guys, that's it. I am going to go take 5 minutes. I'm going to stretch my legs, refill my water. I encourage you guys to do the same. The longer you sit in front of a market that isn't giving you your rules met, the more likely you are to break your rules. I've done it myself a million times, so that is kind of a warning through experience. I have touched that hot stove. When I come back, we're going to go through your charts, guys. We're going to look at everything that you've posted in the room. I'm going to do it in order. And here's my approach, just so you guys know. I don't shame you if you did it wrong. I don't beat you up if you missed something that I recognize. What I'm going to do is I'm going to insist that you tell me what you saw. If you want feedback in this room, you have to describe the momentum and the move, and you have to point to it. You have to tell me whether or not you had a clear path, whether it was the potential to break or whether it was into a termination condition. And I want you to show me where you entered and where you exited, and I want you to tell me why. And I'm going to tell you again, your annotation is not for me. I can read your charts. I know exactly what you were doing, and chances are I know exactly what you were thinking. I want to see how you're reading these indicators so I can give you the best feedback. I want to see where you're entering so I can give you the best feedback. I want to see where you're exiting so I can give you the best feedback. Yeah, Andy likes the abuse. And guys, every chart that I look at, no matter what kind of trade it is, we will go back to momentum, path, and entry. So if you show me a winner that trades into a termination condition, I'm not going to focus on the money you made. I'm going to focus on the rule that you broke and let you know that that's not a high probability scenario, that that is a trade that might lose more than it wins. And in your head, you're saying, but Mark, I won. Guys, your money doesn't affect me. I don't care about your money. Nobody has ever bought me something pretty with their winnings. What I care about is your longevity. What I care about is your chart reading. That's my job. My job is to teach you these indicators so that you can make good decisions. So tell me how you're reading them. I'll tell you if you're reading them correctly, and we'll see if you fit the plan. We'll see if you're following the rules that you wrote on the chart. So go take a break, guys. Relax for a minute, and I'll see you in 5 minutes. Here we go, second hour. So I'm going to scroll to the top. For those of you that aren't familiar with my classroom, it means that I'm going to go to the very top of the chat box. I'm going to click on pictures in the order that they were presented. We're going to talk about each chart, and what I'm not going to do is mess with you guys other than giving some feedback. I wanted to share this picture before we get going on it. I was watching YouTube this morning, going through. I dropped the video in the room if you want to watch it. It's an 8-minute video. But what it is it's Mark Douglas. And Mark Douglas is a trading psychology person. He's no longer with us, unfortunately. Rest in peace, Mr. Douglas. But John Novak worked extensively with him in the 90s. And you'll notice that a lot of the teaching, the thoughts of how we teach, come from what he taught. So I like this so much that I took a picture of it. Evolving into a professional mindset, guys. The most successful traders love the process of trading. The most successful traders love the edge and the advantage that their rules give them. But the typical trader usually ignores the process because he is obsessively focused on the outcome. He or she. Let's not just make this on the men here. And guys, this is one of the most true statements in my experience training people to day trade. Is the most successful traders focus on the process, but the typical trader focuses on the outcome. So I encourage you guys every morning, focus on the process, and the results tend to follow. Ron says, guys, welcome to the Chili Dog. Odds favorable momentum leads the way. Strong triggers leads the way. And that's, I told you, that's part of the core. Almost every trade that you see is going to have strong triggers. Ron has developed a trade that says when the back of price clears trouble, when the back of the bar gets away from the decision-making zone, when the price gets away from the area where decisions are made and the momentum is up, he'll find an opportunity to get in and out with that momentum. Base hits pay bills. I love that. This is what's called the Chili Dog trade, guys. And it's becoming more and more popular in this room, and I think everybody that trades it successfully should send Ron a thank you card. Because it really is an outstanding trade, and it really does focus on the advantages. It focused on momentum and path. All right, here we have, I forgot who I clicked on here. All right, Pete's got us twice. Let's see what we did here. Strong bottom. Market reversed. I didn't when you got in though. I love this. Nice downtrend. Odds favorable. Waited for the clear path. All of the best language you could ever hope for. And Pete says, check it out. I'll go from fib to fib. Beautiful. And then the fib holds. And when the fib holds, the triggers roll. And Pete says, you know, when a termination condition reverses the market, there's opportunity the other direction. And sure enough, you got it, Pete. Absolutely beautiful trading. Embracing those ideas. Technically not a strong top, as Triggs got through first fib and price never reached the second fib. Great read. Talking about strong tops or bottoms, Pete knows that if the triggers get through, it's not. Market reverse, triggers rolled down and separated. Odds favorable momentum. Lots of terms in the way. He's identifying momentum and path because once Pete knows what he's up against, he's going to get a better idea of whether or not he needs to manage assertively. I love this. Enters beneath the fib with all the momentum. Target was 1-to-1s, made a little money. Didn't trade directly into the fib, but rather took the 50-50 trend trade out at trouble, balance off of the fib. Guys, this is what you're all going to do. So those of you that are new going, man, that's not a trend trade. You're right, it's not a trend trade. It's an amazing chart read. But that is the 50-50 trade. That is the trade that you have on your trading plan given to you this morning. And that trade from 73.05 to 72.81 is $240 worth of profit on 2 contracts. And then a conservative exit, another 200 right here. Guys, this is a $440 trade, and it happened inside of 10 minutes. And it's all advantages. Pete, great trading. Thank you for sharing those. All right, Rob. Everything says up, nothing in the way. Rob gets in when he clears trouble. Rob gets out at trouble. Beautiful. We saw this one yesterday. I love that you're posting it again. Nicely done. Nicely done. Let's go down and let's see what we have. Marty says, perfect loser, Mark. Oh, NASDAQ will get you, won't it? Odds favorable. Market clears. Room to the target. In at 10. Out at 6. So what is that? That's 4 points. 4. That's only 16 ticks, Marty. That's tight for a NASDAQ trade. 16 ticks is tight for a NASDAQ trade. That's a big, angry market. Great, though. Followed your plan. I'd take that loser all day long. Nicely done. I personally don't take this style trade on the NASDAQ. I think the NASDAQ's too erratic. But that's my 2 cents, my opinion, not at all fact. Well, do some study. Don't take my word for it. Do some study. Don't take my word for it. All right, Miss Jen waited for price to clear. Took an entry on the way down. Took quit profits. You were looking for the fib and it didn't quite make it. Out break even on the second. Sometimes you only make a couple bucks. The entry's easy. The management's beautiful. Better than a loser. I don't know. Is it? That's a pretty kick-ass loser. It's great management. Momentum-based trade. Exit with a loss of momentum. Break even. Why give it back? The trade's so nice, you post it twice. I like it. Nicely done, Miss Jen. Did you mean to post the same trade twice? No, I don't mind at all. Drop it in. I'm not sure what you posted in there, Bob. All right, Tracy, let's see what you're doing. And Jen, we will come back to yours. Tracy loves it too. I love this. More than a bar between the large triggers and the mid band. Price tends to return to the mid band, but you get in on the way up. So, guys, what Tracy did is Tracy said, hey, check it out. The market hit a termination, the triggers are weak, and you're a little aggressive on the entry. He gets in once, says, let's see if it wants to bounce. And then gets in on the second, says, let's see if they make that mid-band from this termination. And as long as he is on the left side of these small triggers, that market's going to go up. And it's absolutely beautiful. Tracy, great execution, finding a way to capitalize on those terminations. All right, trade one, bought this, sold the snapback and stopped out. Happens. And then you take the entry again. Whew, Jan. Strong top. Trade one was 50-50. So you tried the momentum. And I see why you tried the momentum. It just didn't work. That happens. And then it comes back, and I'm trying to see where you got in. At 72, you get in back below the fib and take profits all the way down. One runner should not have sold Friday and brain not working well, have a cold. Oh, I hope you feel better. But Jen, there's nothing wrong with this. You said disaster. I think that's what you meant to say. You tried it with the momentum. It's 72. The only challenge there is you had the fib. You were looking for the momentum style trade that Nexgen teaches. So now, Jen, you're up to 3 or 4 trades in your trading plan. instead of the one or two that have been proven to bring you success for as long as I've known you, the last month. I know, but you didn't buy it at the snapback, did you? You bought it below the snapback. The snapback is the fib. You're waiting for it at 24. You're not waiting for it at or 74. You're not getting it at 72. You're getting it at the fib, literally. And then your risk is minimal. And then if it loses momentum, then you're good. A couple up bars, you're out of that trade. And then that one, you're doing the same thing, but you're still sitting on the same fib. And you're on the wrong side of momentum. And I love that it worked for you. And it's okay though. You got out on the good side of disaster. And I appreciate that you posted it. And guys, I'm gonna say something, and I'll never tell you when to trade or when not to trade. Brain not working well, have a cold. Jen, is your life going to trade drastically if you choose not to trade when you're not feeling it? Like, you'll still eat tomorrow, right? If you decide not to trade today because your head's not clear. I took the COVID losses. I tried to trade on Corona once, and oh my gosh. I lost. I couldn't think straight, and I thought that I could. I convinced myself. I knew I didn't feel well. But I traded anyway, and it was disaster is the best word. So guys, it's okay if you're not in that frame of mind. And here you go. You know that I have something about it, right? Straight from our friend Mark Douglas. Am I in the right frame of mind to trade? Gauge your state of mind. So, good stuff. Go rest up. Enjoy your weekend. Snuggle with your pets. Always. You're trading with the good side of everything. You needed that entry, so fantastic. Let's see where we're at next. Tracy, I think I missed one of yours. Did I? We had one, and we saw that one, and it was beautiful. And then Tracy's second one, it says good bottom. So we've got momentum happening, but we don't have a clear path. And he says, with this look, all this momentum coming from this fib, that's my entry. And it didn't get him, which means that it just wasn't his money. Just not his money. That's a part of it. Let's see. Price hits the mid-band. Large triggers are a full bar away. And Ron says that's the gap theory, not a trend trade. When price reaches a mid-band and the large triggers are a full bar away, price is likely to close the gap. And this is the exact same time. And let me show you, just straight from the trend trade, the definitions, or from the termination condition definitions. A large chart mid-band, if the large triggers are a full bar away, is a termination condition. Oh my gosh. Jen, go get a hotel room. That's a lot of kids in one house. That's the gap theory, guys. It's not a trade, but Ron says if price is more likely to close the gap to those triggers, I'm going to go short down to those triggers. And did it wonderful. That's the pirate trade. All right, 10K. Good morning. What was the example you gave about NASDAQ and a girlfriend? I need to write it down and put it on my wall. The ES is very slow, and the same is true for crude, but NASDAQ is killing me all the time. I try to remind myself not to do it, if not to do it. 10K, I said once that the NASDAQ is the angriest redhead that you've ever dated, but you can't seem to stop going back to. It's enticing, it's beautiful, it's exciting, but it just leads to heartache for so many people. That was the analogy. And right now there's 10 guys in the room going, man, I dated her. And there's probably a redhead going, that's not fair. So don't get offended. But that was the analogy that I used. And I used it because I actually had a redhead try to run me over with her truck. She clipped me pretty good but didn't kill me. And I ended up dating her a second time. Maybe a third time. Me too, Bob. I just married the one that didn't try to run me over. All right, guys. Steve Diego. Let's see what's happening with you. It's just, and 10K, you're welcome. I come up with analogies. I'm horrible at analogies, but they make sense to me. Like the large crowd reacts at areas. Guys, I don't know if that's a real thing, but it helps me. Pete, I did. I'll go back to him. It helps me to think of it as the large crowd reacting at areas. It helps me to think of it in terms of I don't want to fight that big crowd. And I don't know if that's accurate. The large crowd reacts at a fib. But what I do know is that if you have that mindset, you're less likely to trade directly into a fib. Floor is lava, right? So let's see. NASDAQ. Everything says up. And Steve just takes the trend trade beautifully and out of trouble. Nicely done. And then the same look, potential to break, gets in right at the bottom, and it just doesn't work. Two great trades, Steve. One of them pays you and the other one takes it back. And welcome to day trading. It just works that way sometimes, doesn't it? All right, Bob. Bob, did you delete a picture and then repost it? I think you did. I want to make sure, because I saw one, I want to make sure I'm not missing it. So odds favorable momentum, not a clear path, not inside of triggers, no trade. I love this picture. So, because it's Friday, because I'm getting to the end of the pictures, guys, I'm going to tell you why I love this picture so much. Because I think pictures are the way to do it, guys. Pictures are the way to do it. Hold on. Steve went into term on, you had a 50-50. You didn't trade into a termination condition. You traded a 50-50. Smalls have smashed through the area. Momentum is there. Larger are trying to break, but they haven't. You enter right at the area at the bottom of the triggers, and it doesn't work. That's it. The area had the potential to break, and it didn't. Does that make sense? What comment are you looking for? It's not into a termination. It's a 50-50 trade. At the pullback to support inside of favorable large triggers, feel like a crash dummy with flashing yellow 1-to-1s, a brick wall ahead, but your trigger lines were so far above it, dude. This is a great looking trade. The only thing I would say is that 4 ticks below those triggers, you're pretty much there. This is beautiful. You took a shot with all that momentum from a strong bottom that these 1-to-1s weren't going to end the party, and they did. And you took it from the best spot. I love this trade, Steve. This fits everything for a 50-50. It's awesome. You wanted something to be wrong with it since it was a loser, didn't you? Has anyone else ever done that? I wanted something to be wrong with it. It didn't win. I want to know what I did wrong. You didn't. You did everything right, Steve. It's just a cost of doing business, brother. And that's, I think, one of the great things about this room, too, is sometimes you think you've done something wrong and you want to beat yourself up. But the reality is the trade just didn't work. And that happens sometimes. So, Bob, I want to talk about why I like this picture so much. Because you talk about momentum and you talk about path and you define entry and you do all those things that I suggest you do every day if you really want to be successful with the software. And you didn't take the trade. And it went up anyway. And you didn't take the time to annotate, I'm so mad it went up. I'm so upset that this one went without me. This is BS because I should have been paid. You said, man, my rules weren't met. There's no trade. And more often than not, that results in some level of losing rather than breaking through. So, man, just props. And I think that's the first chart you've posted in here. So welcome to the feedback. And then I want to do this. The pictures that you take, guys, the pictures you can take. This is my approach to every trade that I take. You don't have to use it, but I find that this gives me the most information and the best study and the quickest path forward. So I take a pre-trade picture. When I set my limit order, I snap a picture. I don't have to annotate it right then. I really don't have to annotate it at all. I'm going to go back and I'm going to make sure that I didn't miss something in my analysis. And this becomes extremely helpful on losing trades. And if I did, I'll start to see that pattern. If I did miss something in my analysis, I'm going to start to see it after 5 or 6 of these pictures, and I'm going to focus on improving my analysis. And I'm going to ask that guy in the room for help for the analysis. I take pictures during the trade. Sometimes I take up to 5, 6, 7 pictures during the trade. It depends on how the trade is moving. Did anything change? And I use that phrase. What changed? What changed in the trade? Did I get 3 divergences? Were my triggers still strong? And stop movements are recorded. Every time I move a stop, I take another picture. And again, there's no reason to annotate in the moment. You'll use this to come back and you'll start to develop a management plan based on these things that happen inside. I take a picture after the trade. So when I'm done, when it's all over, win, lose, or draw, I take a picture. And this is where I go back and I write my rules on my chart. This is where I talk about the advantages and the disadvantages. And this is where my entries and exits are very clearly defined and shown with the Y's. And then I also take the picture, and Bob, this is you. And guys, I take these all morning. No trade, rules not met. And I talk about why. And this is the reinforcement that the rules are the lifeline, that the rules mean everything to me, that the rules are the reasons that I do the things that I do. And they've been proven to win more than they lose. And my best shot at trading longevity comes from following the plan. And everyone was like, you don't take that many pictures. And guys, I think I do it every day. When you go back to pictures, this isn't even a real chart. But this is me taking pictures and defining that I'm not going to take that next trade because my rules are met. And this is me saying there's fibs there and I don't have my rules met, so I'm not looking. And where else? This is me saying 3 divergences at a fib and there's a huge gap and my rules aren't met and I'm not taking that trade. So guys, I don't just say, hey, this is a great way to do it. This is what I do every day. There you go, Steve. That's also in the, oh no, it's not in the zip file. But these are the 4 trades that I take. And then let me go to the final little thought on it. Pictures 3 and 4, guys. The trade from start to finish and the no trade pictures. These are the best ones to post in the room. These are the trades that give you the best feedback in class because it makes sure that your chart reading is correct. And that's the goal, is to make sure that you can read these indicators accurately. You'll get feedback on entry and exit, any thoughts on reducing risk or increasing profit. If it's the no trade picture, it's a great lesson too. And I want to show you what I mean when I talk about the no trade picture being a great lesson. And this is just me dragging out class a little bit, guys. So if you post this picture in my room, and you say to me, Mark, no trade. And let me show you some of the common things that I see when people post these pictures and they say, I didn't take a trade, my rules weren't met. One of the big ones is I will have somebody tell me, hey, termination, no trade. This was me for a long time. So if you post in the room and you say, well, I reached a termination condition, so I couldn't take my entry. What it does is the lesson comes out of it. And we say, hey, let's take a second. I get it. You saw one-to-ones and that's terrifying. But let's go back and revisit where termination conditions are defined, where areas are defined. And let's talk again about what the only reason the small chart should ever keep you out of a trade. So it turns into lessons on where you find termination conditions. It turns into a reminder that only 3 divergences keeps you out. And that's a pretty common one. And I was notorious for letting the small chart keep me out of trades. Another one that I see a lot is smalls turned against me. Has anyone stayed out of a trade for that one? Smalls turned against me on the small chart. I don't want to fight those small triggers. That's And then once again, we go back and we say, but Bob, momentum is defined on the large chart. Momentum is defined on that big chart that gives the big broad stroke of a brush. And on this picture, what I'll do is I'll remind you and I'll show you this. During all of those things that terrified you on the small chart, the large chart never changed. So guys, sometimes your no trades are an awesome reinforcement of the rules, and sometimes your no trades are a great way for me to remind you that there were more opportunities than you saw, that there were more advantages that you saw, that your chart read was on the wrong chart for a couple concepts. So Bob, thanks for opening the door for that with that picture. And I dropped that document in the room. And guys, I'm telling you right now, the more pictures you take, the faster you're going to get to where you want to be. Kurt, this is more of a hypo or potential. So I'm going to start here. Potential termination condition. Kurt, are you with me? Price reached an area and the triggers didn't break. Is it really a potential termination condition, or is that a textbook Mark could teach a class with a termination condition? What do you think? No, it is. So here we go. This is why pictures come in, right? So you say potential termination condition. Kurt, let me tell you what I say. And let me know if this sounds familiar. Price reaches resistance. All my triggers are below. This is a term. Rule 2 not met. Oh, hold on, one more. No clear path. So that's what I teach every day, right? Every day when I say price reaches an area and the triggers remain below, I have to sit on my hands and do nothing. I don't know what's going to happen. And then Kurt says, but look, I've got a clear path. I've got a clear path. And then the lesson comes in. My path is clear until I reach the next area. And then the process starts again. So this is awesome, Kurt, because this is common. You will not look at this fib because this fib just broke. And you're like, hell yeah, I finally have my clear path. And you choose to ignore the trade. And then you start saying things like, well, it's only potential. Well, my smalls aren't completely outside of the large. I don't know what that has to do with anything. And you were looking for an entry right here, right? Directly into a termination condition. And that was the S&P. Is this morning? Is this from this morning? So let's just go look. What time was it? Was it this one right here? We have different looking charts. Was that it right there? Okay. So I love this. I don't even have to go back to the live market. Check this out. Bob said, check it out. No clear path. It almost looks like a potential. And yours is the MES, so it's a little bit different, so it won't look like mine. Okay, that explains it. So it's one of those things, Kurt. If you chose to take this trade, and I'm not saying don't take it. I'm not telling you don't take that trade. But if you annotate truthfully, what is your challenge? My challenge is the termination condition. Can we agree? And watch this. I'm going to do this. I'm going to do some big old honking arrows. That is problematic. This strong bottom is nice. That momentum is nice. That cleared fib before it is nice. The uptrend, the triggers up, the fib inside of triggers is nice. If that fat fib wasn't there, did the triggers look okay on the small? Absolutely. Everything's cranking up, man. Your large and synthetics are totally overlapping and you have a fib inside. So Kurt, this is the bar fight. I have the captain of the chess club against me. That's the term. I've got 7 drunk rugby players behind me. That's my advantages. If I choose to fight, that fib is where the chess guy may pull a gun. So you identify your challenges, you identify your advantages. If you choose to take this fight, if you choose to break your rules, you know precisely where things can go south. You know exactly where you need to manage aggressively. And even more importantly, you know that if something changes on the way to that point, you might need to jump ship. Make sense? If you've never been in a bar fight, that may not make as much sense. If you have been in a bar fight, you know it's better to have numbers on your side. So there you go. And that's a lot. I hope it makes sense. And my apologies if any of you are really tough captains of the chess club. Great stuff, Kurt. Great lesson. But I like to go back and say, hey, it was a termination, not a potential termination, right? It was a termination, straight up 100%. And the only reason I say it isn't because I'm telling you don't take the trade. It's because I'm telling you, know what you're up against. Know where things can go south. Know where it might get bad. And that way you can manage assertively. Great stuff. Who is this? Morgan. Those are not train track triggers, Morgan. Are they? Not even. So here we go. We're going to do 3 things on this. The first thing we're going to do is we're going to say, Morgan, I think you're mistaken. This is textbook weak triggers. Small's inside of the large. The scissors are closed. Anything can happen up or down. Fair enough? And if Morgan's like, no, Mark, that's a strong trending market. And that's what you were thinking, isn't it? You were like, dude, but that's a strong trending market. And in a strong trending market, I just assume that I have odds favorable momentum. Is that fair? And that's okay. But then we go to the second lesson. Okay, so you knew it wasn't a strong trending market. That reversal bar negates it. And then let's go to, just to show you what he means with those train track triggers. In a strong trending market, you'll get a look like this. And this is where going back to the materials is awesome. If you go take 20 pictures of what it means to have those triggers in a strong trending market, you never show me a picture like this and say they're strong triggers, right? You know what you're up against. But once again, Morgan bar fight. Morgan says the trend is up. And I'm just going to put words in your mouth. I'm going to tell you how to feel, which is why our relationship will never work. Morgan says, check it out, Mark. Smalls are up, large are up, trend is up, path is clear. I know I don't have the best momentum. But look at my small chart. My small chart says synthetics are up, large are up, small are up, and Morgan is so stinking smart. He is so stinking smart that he says, momentum isn't defined against the synthetics. I've got odds favorable momentum on my small chart. You better believe when I get above problems with every advantage I could possibly hope for, I'm going to grab $100. Morgan, this trade is beautiful. It's awesome. It's amazing. It's well thought out and it's beautifully executed. But I'm obligated to say it's not train track triggers. And guys, that's how this classroom works. I may point out that your read isn't accurate per the lessons, but your trade is amazing per the advantages. And that's what trading is, guys. It's identifying enough advantages to get you into a trade. And then the train track triggers, what you'll see and what Morgan's talking about is, see how you go from strong triggers, Kurt, and then it goes to weak triggers. And I'm like, I don't know what's going to happen. And then you'll get this look right here in a market that's just railing to the upside. And you're right, Morgan, that looks like it. But that's the look. And when you have this look and the market's gone 30 bars in the same direction without a reversal bar, that's a strong trending market. And check it out, Morgan. There's those weak triggers and a big retracement. But I want you to see the other side of it. Is you had the momentum when you took it, and when those weak triggers turned things, you started getting divergences. The smalls started working their way back inside. Dude, it was a great trade. Great looking trade. You just got to be aware that the momentum's not perfect. Awesome picture. And guys, I'm turning lessons into longer lessons. And when the guru himself takes the same trade, you know that you're engaged in advantages. You know you're doing those advantages. With price coming up like a guided missile, quick in, quick out, just get on base. Price completely clears trouble by a tick or two. So Morgan, you just taught Ron how to take this trade. Clearly you took it first. But one of the things that chart reading does for you, is it has you talking about advantages, guys. You literally start talking about everything that's good. And you also identify what could be problematic, and that's what creates management plans. Ron, beautiful trade. He got 50 cents before you. You're impatient when it comes to annotating. That's okay. So when should you annotate? If you take that trade, go back and annotate when the market's doing this garbage. Right? Go annotate it 10 minutes later when there's not something to look at, when there's not the potential of having to manage something. This is when I annotate. Let me go back to that trade, talk about what I saw, what I did, because there's not a damn thing for me to do right now. That's when annotation should happen, guys. All right, who's next? Miss Jen, I have a feeling I know what this one looks like. There it is again. Back of price clears trouble. Every advantage is there. In and out. I mean, come on. Beautiful trading, guys. So that's 3 different people on 2 different continents, different time zones, different zip codes, one on the left side of America, one on the right side of America, and they all took the same trade. Why? Because it wins more than it loses. That's the one thing that I get real excited about in this classroom, is when I see people from all over the world taking the same trades because they know that it works, because they studied it, because they practiced it, they believe in it, and they refuse to miss it when there's that many advantages. You guys are my heroes. You have this photo, which is why you thought it was the train. Oh, because of the one that I showed. That was like right pre-train tracks. I got you. Good stuff. And man, that's the end of the picture. So let's see what the market's doing. 3 divergences right at a key area. And then it breaks. Weak triggers. And it retraces deeper than the areas inside of favorable large triggers. And you can't find your rules met. Whoa, there's my untitled workspace. Let me close that out. Sorry about that. Then crude oil. There's those same darn weak triggers. There's somebody's chili dog. It's been fun, January. You got 70 degrees and you think you're going to do something loud. I like that. Time to take the bike out. Cool. Be safe. Look out for cars. Appreciate you being in here, Ron. And man, I sent you the message saying it, but I appreciate that you shared your trade with so many people. And so many people are finding success with it. I hope that feels good. Marlon, it can be for some people. It can be for some people. For some people, it's more information than they need. But for the NASDAQ, that 21 range can help a lot. Keeps you from fighting a lot of things, doesn't it? And thank you. I saw how helpful you were trying to be yesterday. Thank you for that. That's pretty cool. I saw y'all's little back and forth and how you were offered a Zoom meeting to help somebody. That's amazing. That's what makes humans awesome. I like that. So guys, we made it through the second hour. Weak triggers, no areas inside of favorable large triggers. Would have stunk to keep getting knocked out of that trade, wouldn't it? Can't go short into support. And yeah, Ron, the 21 is a NASDAQ thing. Without a doubt. My rules say don't go short. My rules say don't go long. That's the go fix the sandwich pattern, guys. So what I'm going to do is I'm going to walk away for a little bit. And I'll be back in about 5 minutes. When I come back, this classroom belongs to you, ladies and gentlemen. Show me pictures, ask me questions, put me through the ringer, whatever you need. It's your classroom. I'm out of things to talk about. So I need you to tell me what I'm going to talk about. And that's when the classroom gets great. So I'll be back in 5 minutes, guys. Go stretch your legs. Last hour. Do the blue and pink marking on the charts mean buy or sell? Rob, I don't know what you're talking about. Show me a picture, please. What chart? What arrows? I don't have any arrows. Hey, Tony the Tiger. Do you remember this pattern? Bad top, mid band, large trigger's not a full bar away. We saw that one yesterday, didn't we? Pretty cool. Rob, I'm not sure. What chart are you talking about? Are you talking about the market flow chart? Here we go. Thank you for that. It's so much easier for me to see these things. Okay, so these are your trade markers. I got you. I was thinking something totally different. So there's two sides. We'll just turn this into a whole big picture. If you take a short trade, the pink on the left side of the bar shows where you entered. So your entry is up here. It says entry, but that pink arrow shows exactly where you went short. And then the blue arrow shows where you got stopped out. So when you have something on the left side, it's an entry. Pink is short, blue is long. When you have one on the right side, it's an exit. So there's some people that they don't like the text. And they'll do, if you go data series, you can do text and marker. But once you know that little recipe, you can do markers only. And, whoops, I guess I should have an account, right? So if you bought it, and I'm not saying this is a trade, you'll see that blue arrow on the right side without the text. And then when you close out, you'll see the pink arrow on the other side. So you can still get that precise. Good question, Rob. I don't think anyone's ever asked that question in the room. But that's all it is. It's showing the exact price of entry or exit. Left side is entry, right side is exit. And it doesn't mean buy or sell. It means that you bought or sold. It means that you actually had a transaction there. Buy. But the thing is, Rob, is it's not necessarily, it doesn't mean that you bought the market to go long. It means that you have already sold it and you bought to get out of the trade. So it depends on which side. Okay. It depends on which side of the bar it is. I like that question. And they're just grinding up, aren't they? Multiple divergences, huge fights. They're trying to figure out what to do here in the S&P. All right, guys. What do you want to talk about? It's Friday at 11:08 a.m. and this is where people get quiet. Here we go, Tracy. You have trouble getting entries when it doesn't pull back to your entry, like on your second pick. After several times, you get impatient and make bad ones. Do I need to just keep waiting till it works, or am I reading wrong? Great question, Tracy. Let me go back to your picture, too, because I want to talk about it. Because it was an awesome picture. So Tracy says, check it out, Mark. I've got momentum. I've got the potential to break. I know where I want to get in, right? And they just didn't come get you. And it's crazy, and people don't always get this. Yeah, I do, Rob. Sorry. Not my money, is it? So what happens, Tracy, is in trading, And here's the whole day. And I don't know how much opportunity there was today. So let me address that. You say that it happens more than it doesn't. You think you need an entry more often than it gives you one, right? Do you have rules? I'm assuming yes, absolutely. And you've studied your rules, right? So if you went back and found this day and you're trading, I don't know, oops, hold on. I let that line head fake me. So there's a lot of, oh my goodness. Okay, so here's January 30th. I wake up at 6 a.m. and I trade until the market closes at 3. How many opportunities do you suppose there are in all of that? And of course, high probability trend trade and medium probability trend trade, right? Maybe 7 to 10. Does that sound about right? About 7 to 10? And I say that because we're looking at about 10 hours. 60 minutes an hour divided by 7 trades. So about every hour and a half, if you just bounce it out right like that, about every hour and a half, there's an opportunity. And of course that's not true because they happen at different times. But if you put that thought in your head that I might wait an hour and a half for a trade, what happens is you stop thinking that in this range right here, you should be seeing 7 or 8 trades. Well, I've been watching it for an hour and it didn't give me the entry. And that's when you start going, damn it, I gotta find an entry, right? Does that make sense, Tracy? I did the same thing. And some days it's 3 to 4 trades. And some days, like the other day, it was like an ATM. There were like 20 trades. So you trade from 4 to when class is over a couple days a week. So let me tell you a story about me, Tracy. When I first started and thought I was going to go live, and let me do this again. The busiest part of the day, typically, any day, is from the market open until about 11:30ish, 12 Eastern. This is typically the busiest part of the day, right from the open right to lunch, right? So you have the opportunity to be here for this. I had this section and I had this section, and what I would do, Tracy, is because I knew I was on a time constraint. Let me do this. Because I know I only have a couple days and a window inside of that couple days, I feel compelled to force the market to do something. Why? Because I want 5 days a week profits, but I only have half a day a week. That was my mindset, Tracy. It killed me because I tried to force trades. Because I wanted to make $700,000, $800,000 a day. And I wanted to do it 5 days a week, but I could only trade 2 days a week, which meant that now I got to make $2,500 a day, or I'm not making what I want to make annually. And I have to be able to force these trades into an area when maybe it's not giving me what I want. Um, and it sucks because 90% of the day isn't trading. And if they don't want to give you rules met during your part, um, you're stuck out, unfortunately. And I can't tell you how many mornings, Tracy, I've woken up at 5 in the morning Central and come to teach my class at 8 a.m. Central and never had a trade. And then I sit in this classroom and I watch all of you guys catch trade after trade after trade after trade. And then when I go back to it after class, I feel like I have to make up for everything that I missed. Um, does that make sense? It may not make you feel better, but I hope it makes sense. Yeah, just hoping to be profitable. So you just got to take what it gives you, right? And if you have limited time and a limited window, you can't force it. What trades are you looking for? Can I ask that? Are you only looking for trend trades? Sometimes adding a trade to the plan's not a bad thing. You've got to study it. I'll help you. But sometimes you got to add a trade. Maybe I'm not going to find all the trend trades that I want, but I can find an HVA trade. You look for the back to the mid band. So you're looking for a gap trade and the chili dog trade. So now you have 4 options, right? But you just started that because it wasn't long ago that you asked me about the chili dog. So give it some time and see. And Tracy, one of the things you can do too is you can build up a little confidence on market replay on your off days so that when that opportunity does present itself, you don't hesitate. You are excited to get into that market with your rules met, and you'll know your rules to avoid that hesitation. So. Tony. Great. You're welcome, Tracy. It's a great question. There's a lot of people that ask it. And Rob, these are just a reflection of what's happening. That's it. Somebody's making the market go up and down. You see it on this chart. But what Nexgen does for you is it shows you where the market may bounce. It shows you when the market doesn't have a lot of momentum. It shows you which direction the trend is. So all this is like television. You're watching the news. And everybody's got their own idea on it, right? That's all it is. Mark, last night at 8 p.m. the crude market got really busy. Why is that? You want the answer, Mark? You want the real answer? Because people with a lot of money either bought or sold. That's it. And I know that seems too basic, right? But that's it. So last night, for just a minute, I was looking at the NASDAQ, and I thought, man, I'm going to look at the NASDAQ. I just got home. I wonder what it's doing. And what it did, it was so funny, Mark, because it set up beautifully. It set up perfectly for a trend trade. And it was so slow. It's the trend trade took 30 minutes to set up, like 2 bars in 30 minutes. And then once it hit the area where it was going to continue up from, it shot up. And I got about 30 bars inside of 2 seconds. And it just meant somebody was waiting for their shot, and then once that number got hit, they were all over it. And you never know if that's going to happen, and that's one of the reasons why being on the right side of things is so important. But it happens everywhere. And the other answer is, I don't know why the market goes up and down. Somebody with more power than me makes it happen, which is why I just trade patterns that give me that edge. Good question. And Tony, wouldn't it be great if my brother gave me a cut of his trade since you teach this class? He does. He pays me a salary to teach this class, Tony. It's funny. We were just talking on the break about trading together pre-market and creating a little dynamic duo. But I taught this class. I took over this class from John Novak so that he could trade. He actually said to me, he goes, man, he goes, it's a bummer to build this software and create these plans. He goes, I don't have time to trade it because I'm always working. So that's how I ended up trading the class. So I'm so thankful for my job and what I do. I don't want any of his trading. I do just fine. I got all his knowledge. That's better, which is good. All right, guys, there's your termination condition. Price reaches yellow 1-to-1s, all the triggers are below. It's not a potential termination condition, it's a termination condition. It was 8 a.m. on the other side of the world. Actually, Chris, so 2 a.m. Central or Eastern, 2 a.m. Central, I believe, is when crude oil opens up in Europe. They're about 6 years ahead of us in London, or 6 years, 6 hours ahead of us. Jen, maybe you can confirm. It's about 5:30 there right now. I guess I've got Google too. It's 4:30 right now. So when it's 2 a.m. here, it's 8 a.m. there. And so when it's 3 a.m. Eastern, where you are, it's 9 a.m. and crude oil opens. And that is when it starts rocketing. So it was actually like 2 in the morning, London. They're open 24. You know, have you ever gone to Denny's at 3 in the morning and it's packed? Same thing. You never know when people are going to go. You don't know when they're going to do what they're doing. They just do. Yeah. Bad top, gap theory, everything says up, not a clear path, and it bounces all the way down, and now they're trying to push back up. So that was one of the things that, pretty much, Morgan. That was one of the things that I was doing this morning, guys. When I was waiting for my rules to be met, I took the time. And you guys don't have to watch this. It's not an advertisement or an endorsement for the gentleman who posted the video. But this is about 8.5 minutes of Mark Douglas, taken from an excerpt and then discussed by whoever posted it. And Mark Douglas talks a lot about the psychology of trading. And one of the things that he says is that you just don't. You don't know what's going to happen. You don't have to know what's going to happen to make money. What you need is a pattern that has been proven, that's been seen to win more than it loses. And you never get to pick when it's going to win. And you never get to pick when it's going to lose. Which means that you have to commit 100% to always taking the trade when the rules are met. That's how you get your results, through process. Results are a byproduct of the process. All right, guys, I'm going to go mute. Post a picture, post a question, but I can't keep rambling nonstop, so I'll be here in a minute. I'll be here. Just post in the room.